Hey guys, Pete here, HVAC Greatness. So we're going to talk a little bit in depth about the overhead portion of how to properly calculate your services. So we want to get away from that old gross profit margin and move into the net profit margin pricing method. So without further ado, let's just jump into here and I'll show you a little bit of what this looks like. So if I want to go into this presentation, I'm not going to stay on the presentation, I'm going to pop back and forth, but it gives us a little bit of a visual aid. So when we're looking at pricing your services, when we're looking specifically over the overhead, we want to talk about what the difference between your overhead is, your COGS, which is cost of goods sold, your payroll versus labor, your field labor. There's two different things. And then there's a variable overhead that we like to separate out when we're pricing because you just need to. And then finally, departmentalization. And so let's talk just a little bit about that. So what is your overhead? Well, fundamentally, it's all the bills in-house. So it's your rent, it's the people who work in the office, it's your truck payments, your insurance, and all of that kind of stuff. And so when I put this method together over here, this particular tool, and this is part of the net profit pricing program, I just use this sample for you smaller guys, and you just come through here and you add all your stuff. I mean, it doesn't have everything, but you need to think about every stinking thing that you pay for, and it needs to fit in the overhead, or it needs to be part of what's called COGS, cost of goods sold. I'll talk about that here in a minute. But rent, uniforms, I think they're kind of mixed in here and miscellaneous, but you know, your cell phones, your truck payment, your truck insurance, your training, your internet, your advertising, marketing, tools and stuff that you're buying all the time. And this is not accounting, by the way. This is just to help you price. And then we're going to look at something called departmentalization, breaking that up. And the reason I'm referring to this is, if you'll notice, we've got field labor in what's called the burden, which is workers' compensation. You got to match taxes. If you've vacation days, all that other stuff, you got to finish that stuff in there. And then we have that variable stuff like your gasoline, because gasoline consumption goes up when you're really busy and down when you're really slow. And so we want to break that out as a separate thing because we need that moving in our cash flow. But I wanted to explain what that was on the outset so that when we go through this, it kind of makes more sense. So the overhead are the bills in the office. I guess that would be the easiest way of saying that. But when we're talking about costs of goods sold, yeah, we've got the equipment. Yeah, we've got cranes and subs and electricians and all your ductwork and accessories and things like that, but also your technician labor. Have all of your payroll together, how do you separate the technician labor? And so, but just remember, anything that goes directly into the job is a cost of goods sold. And so when we look at the actual calculator, and I don't know if I have that open up, let's look at the calculator real quick. The overhead is actually broken out, but all the COGS, which is all of this stuff, I mean, we've got your materials cost, sales tax, we got a little bit of contingency and warranty in there, your truck expense, any overhead, any special tools, equipment rentals, permits. If you want to build some of your labor back into the if you waive your diagnostic fee, that's an option there. And so these other things like commission rate and financing, they fall into a similar category. But anyway, the point is that we want to separate this from our overhead in order to actually understand what kind of money we're making on these, okay? So the idea is to make sure that we understand what goes into the job and what's actually paid into the office. And now we'll talk about this one over here. So here's our three basic things that add up to your sales price. Okay, so we've got the overhead as it pertains to that job. If it's a repair, there's a certain dollar amount, not a percentage. That's GP. There's an exact dollar amount that we can calculate and get that right. There's the COGS, right? So that's the labor, the refrigerant, the materials, all the stuff connected with the job. And then what's left over is net profit. And that's what we put the piggy bank there so that you realize the difference. That's not just in the bank. That's what's left over in the bank when everything's paid. Well, it's called EBIT, earnings before income tax. So you're still liable for taxes, but that's your net profit on the job in terms of that, okay? And then when we look at the payroll versus labor, it's really as simple as if they're in the field, they're labor. And that has to apply to the jobs, okay? If they're in the office, they're support, right? That's just your standard overhead portion of the payroll. When you do payroll and all this is mixed together, it can get a little bit confusing. So I just wanted to make sure that we clarify that, because there is a difference and we have to separate that when we're calculating our price, okay? So let's talk about that variable overhead. So when you pay your truck payment, your vehicle payments, that's a regular part of the overhead, because it's a monthly payment that you pay all the time, right? When you pay your vehicle insurance, right? It's part of the overhead. But the thing that goes up and down when you're running your trucks around town, fuel costs, parking, tires, repairs, those type of things, we add all those up and we break it out and we divide it by the number of vehicles, and then we divide that right down by the job based on whether it's an hourly amount like on your service department, or it's a daily amount like on your replacement department. And all that's part of that calculation that we're talking about. Okay, so then you're going to want to make sure that your company is departmentalized. This is really, really, really important. Let me explain that to you. If all of your sales go into one department income, and then all of the stuff that you're buying throughout, the job or throughout the week, that goes into another department called expenses, you're not departmentalized. You just have one company. So you really can't tell how profitable this service department is and how profitable the replacement department is. Okay, so that's why back over here, we talked about breaking these up in departments. Let me show you what that looks like in your chart of accounts. So chart of accounts is how you would set up your QuickBooks, your accounting, right? And so if you used to just call everything sales, now maybe we want to let's call this demand service. Demand service means, like when there's a demand, it gets hot or cold and something breaks, they call us. That's your service department, standard, right? That would be a subset, right? And so if I'm not only, let me back up. When I enter in that sale, I don't put it 3,000, I put it 3,030. It's still part of 3,000, so I can run a sales report. But if I run a report on 3030, it only lists the repairs as a department. And to take it a step farther, if I go to get some parts, well, I'm going to put that in a -30 as well. It's not just the cost of the job, it's -30. So I can literally run each department's report and know by department how much money it's making. Okay? And then we can look as a gross, then we have to actually look at the overhead and break that out. So here's your retrofit, like your change out department. We'll make that kind of a golden here. And the same thing, when you go to pick up your equipment for that department, you would charge against that. So when we run a report, our sales reports, we can run it as a total, or we can run it the service department, we can run the change out department. We call that retrofit. And so this is a chart of account, and it kind of tells you how to set everything up on your QuickBooks. So this is all COGS, and then you start getting out into regular expenses. Notice the dashes are gone. Advertising, that's just all rolled into overhead. Okay, that's just standard overhead. But this here allows you to put your COGS, all those costs that are right there directly connected with that job, into its own category. So when you run your reports, all this stuff makes sense. Okay, so going back over to our little overview here, we've got two basic departments. Obviously, there's more. In fact, let me go ahead and define those for you. So I've got RNC is residential new construction, if you do that. The green one here, we've got service, demand service, that's your repairs. ESAs and CESAs are energy savings agreements, or commercial energy. Those are your maintenance agreements, okay? And then service accessories, we break that out. We break that out because if you have a service technician that's selling a lot of IEQ and stuff like that, and it's all mixed in your average repairs, you don't know what your true average repairs are. And so they get the credit for generating those revenues, but it's separated so we can see where that technician is profitable and where he's not. That makes sense. So that helps us to understand the numbers. Now, you may say, well, Pete, it's just me. I don't need to do all this stuff. You probably should do it because you're going to have employees at some point, if you do this thing right. Okay. And so those are the two different departments. Okay. So just to finish this out, what's left over is your net profit. That's actually what goes into the bank. And the big thing is when we're looking at overhead, I'm going to go all the way back over here. We look at it as a dollar amount, not a percentage of revenue. And I've talked about that before on other videos, but I just want to make sure we clarify that. And so we use what's called the net profit pricing method. This is a snapshot of the one that we've created and many of you have invested in, and it's a wonderful tool. But when you go to do a change out, $4,300 worth of equipment, we actually know what the dollar amount is of your overhead based on your company size, your overhead, your production efficiency or capacity, and which means how many of those 40 hours a week is that change out department actually billable, right? Because we have to divide everything into that number, which leads us back over to here. And when we go into this particular overhead calculator, there's some other tabs, and one of them is that. So how many residential service calls with this little old one-man operation run every month can he count on? What would those average repairs look like? And we start to get a feel for how many installs they're going to do and what those average tickets are, how many, if he has some commercial accounts, how many hours is he billing per month. So it allows us to lay out some type of a quota, right? We're shooting for 35 service calls per month. So what is that per week? I need 9. I need to get 9 service calls this week, and they need to average $700 so I can hit my numbers, right? And in order to do that, sometimes, and this is the next tab, we want to know. Let's say, for example, here in September, we need this small company needs 25 service calls and 2 change outs and 2 accessory sales, right? That's his quota. Well, he's realizing he's going to have to advertise to get 25 service calls in September. He thinks, based on his historical data, he's going to have to advertise to get 12. Well, every time you advertise, that's $300 based on his calculations. Yours may be much less, maybe about this, but these are just some example numbers. But what we do is we say, okay, I need to buy 1 change out as well, which means I got to go on 3 estimates to get that 1 job, right? If you're closing 33%. So I have to advertise for 15 jobs in September. So doing this little scenario, and then you total it out for the year, and you actually can come up with, what your cost per lead is plus your SEO. You can come up with a budget, right? And then we come back over here and you put that number here, which this is a little bit different from this example, but it's pretty close. And then we have a total overhead. Once we have that, we come over to the company's actual setup, and we would set up that for your company. Like this is a big one. $1.5 million on this overhead, but if we change this one to that $158,000, that's how this is all set up, right? And so you can use this to set it up. But the point is, whether it's one at a time calculators or whether you're coming in actually setting up full pricing books, and you can do this. This will all calculate for you if you want to use this tool. But fundamentally, it all starts with your overhead, and we have to know what that is. We have to know the difference between fixed overhead, right? And variable overhead, like on those fuel expenses. And then we have to separate that labor, office staff and overhead, maybe you, the owner, right? And then job related labor. That includes commissions. You can put that right over there, okay? And so all of that's breaking out. So I wanted to cover the overhead so that it kind of makes sense, because a lot of people are getting confused on this. You need to know what that overhead is. You need to departmentalize and know your quotas. And once you have that, you're able to dial in and actually put a dollar amount on every job accurately, right? So as long as you hit your quota, bills get paid, everybody's happy, right? And then everything above and beyond that becomes net profit. Okay. P. Ramsey here, HVAC Greatness. I hope this helped. We'll move on to another one here on the next one. Take care.